Good morning, sir.
Good morning.
Good morning, sir. Good morning, all. Now I request sir to proceed the session. Session is being start now.
Yes, pardon.
Yes, sir. Yes, sir.
Okay. May I? Yes, good morning to all of you. We are having around 50 attendees. Let me wait for 2 minutes so that some other people can join. And by that time, let me share also certain things. Okay, so give me a minute to start, please. Okay, yes. Yes, good morning to all of you. I think now we have enough attendees, and I think those who need to join, they could have joined. So I think with reference to the previous session we have done, starting from the last session. Okay, I think I expect that all of you could have read something and gone through some details. And as today is our last session, so I think if you have any questions or concern, you can address today, or even at the end of the session, I will provide my mail ID and mobile number. So if you have any concern, I think I can address to you. Fine. Okay. With this, we are going ahead. In the last session, we have tried to see a number of things on different aspects, If anyone say "Okay, what we have done in the last session," then I can say we have done the assessment of the companies. Okay, I can say we have done the case studies. Yes, we can say the business profession. So what we have done, we have tried to cover up majority of the parts all together, not in sequence, but all the parts has been taken care over there, right? So with that, we are going ahead. Before moving ahead, I wish to uh, show you, or we need to discuss something about MAT and AMT, as we have a discussion in the previous session. In the previous session, someone has requested that if convenient, we can take up a call for the MAT and AMT, right? I think everybody knows what is MAT. At the same time, all are aware about AMT. Now, what is the basic difference between two? With that, we will be starting. MAT is only for companies. Okay, MAT is only for corporate SSC, while AMT is for other than corporate SSC. So that is the basic fundamental difference over there. One tax planning I have shown you in the previous session. What was the tax planning I have showed you in the previous session? That for one particular company, what we had done, we have started a private limited company in STPI unit, as a STPI unit. So they were getting tax benefit under section 10AA for around 5 years. No tax, no MAT. It was a story, no tax, no MAT, up to the assessment year 7-8. Later on, they have changed that, yes, sir, you are not subject to tax, but you are subject to MAT. Clear? You are not subject to tax, but you are subject to MAT. So what we have done in the next planning, we have said that we have started a new unit for a new client in SEZ. At the same time, kept in mind that now there is a MAT, so we should go in that kind of structure of a company or ownership structure so that our tax liability is minimized. And we had made partnership firm. So situation was good. It is there in SEZ, no tax. It's a partnership firm, so no MAT also. So we are enjoying 100% zero tax. Now, unfortunately, happened that after 2-3 years, they have changed the law also. And what they have made a correction? They have made a correction that instead, those companies who are enjoying 100% tax benefit, those who are enjoying 100% tax benefit, they need to pay AMT. And those who do not have a corporate structure, alternate minimum tax has been introduced. Clear? So these are the things we already have gone through. Let me share my screen, and I'm not going in much detail, but just trying to explain something relating to the MAT question, how MAT is likely to be paid, how the credit can be utilized, how it can be carried forward. That's one question is there. I have taken the question from Girish Ahuja book. Okay, I think, see, I cannot take all answers right now, but I would like to say that in the previous session, I have said you need to read, I can say, marginal relief. How many of you, I can't view, but I am also not going to ask you right now, but I expect all of you could have gone through marginal relief that I have asked yesterday, and expected that, okay, what is marginal relief? There is surcharge. There is surcharge over a particular limit. We have surcharge over certain limit. Now my income is, say for example, previous sessions I'm talking about, in case of a company income is exceeding 1 crore, then there is surcharge. Now my income is 1 crore and 200 only. Legally, yes, there is a rule. I have to charge a surcharge, but there is benefit is available. So it is that. Okay. We have somewhere case studies also, which if you are not going to share separately. So I think we have discussed, see, number of things we have discussed, and we are also going through all the things together as and when they are coming. I think everybody knows advance tax. If my estimated, what is the word? If my estimated tax liability is more than 10,000, if my estimated tax liability is more than 10,000, in that case, I have, if my tax liability, estimated tax liability is more than 10,000, then I have to pay in advance. I think everybody knows advance payment, June, September, December, March are there. If I make a default in that, there are certain provisions are also there. Now, one question is there, based on the Madras High Court judgment, it is there that is interest under section 234B and C, is interest on section 234B and C is applicable on the MAT payment? The answer of the court is yes. 234B and C says that when there is a estimated tax liability, tax includes MAT, that's why we can say that even though you have MAT liability, you have to pay in advance. Is it okay? If you have MAT liability, even though you have to pay in advance. Okay, one by one. I think all of you might be aware about the MAT, even though I just would like to show you question and answer. We are not going to calculate. I will give you the question if needed. I don't know what is the mean of sharing the question with you, but I will talk to the organizer and then we'll send you accordingly, right? So what is the thing? MAT is, see, why MAT has came. Let me take 2-3 minutes in some theoretical aspect. MAT says that, or rather MAT, let us go a step back. There are two separate rates are there for depreciation. There are two separate rates of depreciation for companies, because if you are a private limited company, you have to follow company law depreciation rates. If you are a company, corporate SSE, then you need to follow depreciation rate as per the Companies Act. And if you read the law, if you see the percentage of company law, you may find that the percentage are quite nominal. 3.28%, 5.6%, 6.27, something like that. So I can say that the higher range of the percentage goes above 15-20%, not more than that. On the contrary, if you see income tax rates, then income tax rates are too high. Income tax rates start from somewhere 10%, and earlier, I'm saying before 2 years back, it was ending up to 100% on the windmill or power utility products or equipments. At the same time, on the computers and allied item, the rate was 60%. So there is a difference between two rates. So what was the situation? Try to understand why MAT has came. Earlier, there was some companies, what they used to do, I think everybody knows how to calculate business profession income, even though I'm just trying to share basic format of that, not in detailed format. Everybody knows that net profit as per P&L account, add disallowable expenses less disallowable incomes, and whatever is the answer is your taxable business profession income. I think everybody knows the same. Now, what is the situation? What was there before MAT? Before MAT, what the company used to do? Net profit as per P&L account, depreciation as per accounts, or we can say as per company law. So I'm writing the word accounts. As per account, the rate is hardly suppose 10 lakh rupees, and depreciation as per income tax, which section? All of you, 32. It is around 80. So situation happens like this, that company is having a positive answer over here, suppose 30 lakhs. They are having a positive answer over here as per P&L account, but whenever they are going to calculate depreciation over here and depreciation over here, their answer goes negative. Is it okay? Their answer goes negative 40 lakhs. Now they need not to pay any tax, but they are paying a dividend because there is a positive sign. Now this kind of tax planning was done by number of companies over a year on year, because I think everybody knows that in section 32 you are going to get 50% depreciation. Yes or no? Even though you are buying on the last date of the previous year. So if you're buying some asset and put to use also on that particular date, on the last day, even you are eligible for the 50% of the depreciation. So this kind of planning was done by number of companies. That company is also known as the zero tax company at that time, zero tax company. So now income tax found that yes, this kind of planning is done. It's not illegal, but it is a planning that we want to buy the asset in that way, in that fashion, in that installment, so that I can reduce my tax or I can make it zero. So to avoid this kind of situation, the income tax has come up with the provision of 115 JB, that is talking about MAT, and they says that MAT is required to be paid if your tax on regular income is less than 15% or whatever percentage of the MAT of book profit. Is it okay? Whichever is less. So they are saying that the company need to pay at least 15% of the book profit or tax on regular income, whichever is higher. So minimum they have to pay 15% of the book profit. So that is one answer solved from the income tax point of view. Got the point? Now there was an issue from SSC also. All SSCs are saying, sir, why we should pay the tax? As per your provision, there is no tax. As per your provision, we do not have tax, even though you are taking a MAT. So they are saying that no problem, sir, whatever MAT you are paying, credit of which will be available to you for 10 years as per the latest amendment. Earlier it was 8 years, now it is 10 years. So MAT credit is available to be set off in the consecutive years, and the limit is 10 years, not more than that. I hope it's clear. Fine. Check. Okay. Just to have more detail on that, I wish to take one small example quickly. If I think I found you very quick to answer, I'm writing something over here, and you need to answer quickly so that we can see the question and we can close the point very fast. What I'm writing over here, instead of writing this number name of the year, I'm writing 1 2 3 4 for the simplicity. Let's see year on year. First year means you can assume 17 18 18 19, whatever you think, but I'm writing 1 or 2 3, right? My tax liability as per MAT is 120, and as per regular tax, it means as per the income tax, my liability is 100. How much amount I have to pay actually? Clear? Question is very simple, that my MAT tax liability is 120 lakhs. We are assuming to be the figures are in lakhs, 120. My regular tax liability is 100. How much I have to pay actually? Okay. Yes, both answers are there, 120 and 100. I would like to say that. Okay, answer is 120. Is it okay? I have to pay whichever is higher, so 120. Is it okay? Chali. Going ahead. Second point. Next year, my MAT is 50 and actual tax liability is 35. How much I need to pay? Yes, someone is saying 50, someone is saying 30. I don't know where 30 you have brought, but it is there. 50. See, all of you, answer is 50. Those who are writing 30, they might be taking the credit over here available. I think I can say credit, MAT, credit, carry forwarded. It is 20. No, whenever these things are there, MAT and regular tax, I would like to close with this word. I would like to close with this word. At least, what is the word? At least you have to pay MAT. Whatever the situation there can be, you have to pay at least equivalent to MAT. So here in this case, you have to pay 15. So 15 is carry forwarded and total carry forwarded is 35. Now second situation, now you can do something different. My MAT tax is 70 while my regular tax is 80. Is it okay? My MAT tax is 70 lakhs and my regular tax liability is 80 lakh. How much I need to pay? Okay, I am getting the answers like this: 80, 70, someone is saying 45, 70, 45. 45 is wrong answer. I'm concluding again and again that you have to pay at least this value. You cannot go below MAT. So I can say that now your actual tax liability is higher than this. So what you can do is you can pay this value provided, what is the word? Provided you have available credit of 10, and here I am going to write the word MAT utilized. I hope it's clear. So now what is the credit available? 35 minus 10. This is 20. Is it okay with all of you? Yes. So I have to pay at least this. Now one more last example on this. My MAT liability is 60 and my actual tax liability is 120. Clear? What is there? My MAT liability is 60 and actual payment of tax liability is 120. How much I need to pay? Yes, some people are giving different answers. Someone is saying 75, someone is saying this. I would like to conclude like this. See, at least I have to pay 60. Yes or no? That is for sure. At least I have to pay 60. Okay. Now what is there? My tax liability is 120 and MAT is 60. So I can set off this highlighted field, that is 60. I can make a set off from the credit available if it is available, but I don't have that much credit. I have credit of only 25, so I have to pay 35 this one. So I can say that this 60 plus 35, so answer is 95. It's a one-way answer. Second way answer says that how much I have need to pay? 120. What is the maximum amount of credit that I can utilize? So answer is I can utilize 60 lakhs, but I don't have 60 lakh. I have only 25 lakh. So I can say that 120 minus 25, again my answer is 95. Is it okay? Now if you see over here, this highlighted field, in any of the year, not a single year, the tax value is less than MAT value. Got the point? In no single year, my actual tax value is less than MAT value. It shows that word itself is very clear. If this is the minimum amount that you have to offer. You have to offer to the department. You can go ahead. Yes, you can see over here in this year. You can go for a higher amount, but not less than the MAT liability. Got the point? Very simple. I think I have shown you. You can carry forward this MAT, and later on here you can utilize also. Now coming back to the questions. Yes. Okay. Now one more thing. In examination, you will be given all the rates. You will be given all the rates of the MAT for the preceding years. But as far as the current year is there, you need to remember those rates and you have to calculate, right? So that you need to remember over there. Quickly going through the question. From the following information of R Limited, compute the credit available under section 115 JAA and tax payable by it for the various assessment years. Will any interest is allowed on amount of tax credit available under section 115 JAA? It may be assumed that the rates of tax for future years will be the same. What they have said, future years will be the same as per the assessment year 2021. MAT rate prior to assessment year 10-11 was 10, it was 15 for this, 18 for this, and so on and so forth. Assume the company is liable to pay 30% of tax. So these are the details has been given to you. Now, as I have said also, I'm not going to calculate the whole question, but I'm going to give you the glimpses of it, how it can be calculated and what is the actual calculation of it. Now, if you see over here, what is the MAT rate? Yes, MAT rate prior to assessment year 10-11 was 10%. So I can say that for the year 9-10, my MAT rate is 10%. Income tax rate, as they have said, it is 30%. Yes. So what is there? Assessment year you have been given, book profit you have given, as well as you have given the profit as per income tax. Now what you need to do, you need to calculate MAT on the 60 lakh and income tax on this 10 lakh. So if you see in this table, my MAT is 6,18,000 and income tax is 3,09,000. I think everybody knows it very well that on tax value or on MAT rate, how much additional percentage are available? Education cess and higher education cess need to be paid at the rate of 3%. So here in this case, how they have calculated, being a first year, I'm calculating 60 lakh into 10%, 60,000. I'm sorry, 6 lakh. On that, 3% will come to 6,18,000. Same way, I'm having a profit of 10 lakh on that 30%. So that comes to 3 lakh. On that 3% will come to 9,000. So this is the way you need to calculate the tax for MAT and for income tax. All these tables you need to calculate. And now we are going to just view it, not going to detailing it, just going to view how it is taken care of. What is my MAT? 6,18,000. What is income tax? So I have to pay 680. Clear? MAT 680, normal 3 lakh. So I have to pay how much? 6,18,000. So I can say that whatever higher figure I have paid, so difference of this two is carry forward. Next year again same story, 12,36,000. MAT is higher, normal tax is lower, so I have to pay this higher amount, and 8.65 is carry forwarded, so my total credit is now 11.74. Next year 23.91, and this, so same story, I have to pay higher amount and carry forward it. Fourth year is different, as we have calculated ahead. Now your income tax is high and MAT is low. What is that? Your income tax at 27 lakh 81,000 is higher than the MAT of 19 lakh. So how much you need to pay? 19. How 19? First you need to recalculate that the difference between these two must have available credit. The difference of two is 8.75 and credit available with you is more than that. So yes, you can enjoy the credit, you can utilize it, and you can pay equivalent to tax. Yes, in between I am adding this word that no matter whatever is profit loss position is there. What is there? No matter whatever is your loss or profit position is there, you cannot pay. See, we have, I hope all of you can view it properly, 28.24 lakh highlighted field. That much credit is available. I have 28 lakh credit is available, even though I cannot utilize, I can utilize equivalent to difference between two only. Are you clear? So that is the theory with which we can go ahead and you can solve this question accordingly. Sound my idea? And one more thing, you have to see that you have to monitor over a period of time that your credit is available. Maximum how many years you can carry forward? You can carry forward up to maximum 10 years. So you need to see that in any of the point, the 10 years should not be exhausted. Fine. Okay. Now give me a minute. All of you can view this company's data. Why I'm showing you this real-time data, so that you comes to know, yes, you can see over here company's name and everything is written. It's a computation of total income. Yes, I think you need to understand that it's a company SSC. It means they do not have salary income. They have house property income, but it is not there. They have business income. Yes, it is there. They could have capital gain income, but it is not there. They have income from other source. They can have deduction under chapter 6A, but they don't have. Now see over here. See, we already have seen the question that was from academic interest. Here I am showing how the real-time companies are working on it. If you see over here, they have made a calculation. Total tax as per the Income Tax Act 42,98,000. Tax payable under 115 JB, that is a MAT. 115 JB they have calculated. What they have stated, surcharge if applicable. So both the way they have applied the surcharge, it means you should be very clear that yes, their profit is more than 1 crore. Accordingly, the tax liability is here 20.39 and here is 45.13. Education says yes, it is there. So here there. Higher education says that is 2% and 1%. Now you can view over here. What is the situation? Now you can view over here that my tax liability is 46,49,000, while my MAT liability is 21,368. Now I can utilize the difference. I can utilize by way of MAT credit, provided you have the MAT credit. You can see over here, I have some MAT credit of 4472 only, that I have utilized and reduced the tax liability. I hope it's clear. And if available, it's not available. Let me. Yes. Yes, you can see this one different example. Same example is there, but this one is a different written. My normal tax liability is 48,37,000, while my MAT liability is 28.96. Yes or no? Now the difference of these two can be set off. The difference of these two can be set off by way of what? MAT. Do I have MAT credit? Yes, I have MAT credit. So what I have done, you can see over here, I have taken the difference of two. If you have calculator and if you calculate the difference, you will get the same answer. 48,37,939 minus 28.96. Your answer will come to 19.41. So what I'm going to do, I'm going to utilize MAT out of 1112. Accordingly, if you see over here, how my tax liability is going to reduce. My tax liability is higher, 48.37. From that, I can utilize the credit, and I have utilized the TDS also. So by doing this, my liability is 26.33 lakhs. Against that, I had advance tax of 30 lakhs. What is that? I had advance tax of 30 lakh. So interest is, I'm sorry, amount is refundable to me. Amount is refundable to me. All of you, please take a note. All of you, please take a note of that. Even though I'm going to have a refund, you can see over here, I have refund. Yes or no? Though I have to pay 234C interest under section 234C. Why? Because in payment of this advance tax, there is a deferment. Tax is more, but there is a deferment over there. Clear? So that is that. Just showing you the table, if available with me, I'm not sure. Yeah, you can see over here how we are going to calculate. Our MAT table is there. MAT table 1112 credit brought forward. I am having a credit of 63,23,000. Note that I have credit of 63,23,000, but I can only set off 19.41. Why? Because you cannot set off more than income tax and MAT difference. More than that, you cannot set off. So I have set off this, and now carry forward date is 43.81. It is carry forwarded in the future year. Clear to all of you? So what I have tried to do, I have tried to show you that how the real life calculation explained as compared to this one is a theoretical point. Okay, so I think okay, now there is one question. Sir, is surcharge applicable on MAT? Yes, answer is yes, surcharge is applicable on the MAT. In case regular income is at loss and MAT is positive, is credit gain that loss? I think, okay. See, if you are having a loss in P&L account as per the Companies Act, if you are having a loss as per the Companies Act, that means as per the books of account, MAT liability may not arise. Fine. I'm using the word may not arise. I'm not saying always not arise, may not arise. If your book income, MAT income is positive and regular income is negative, you have to pay at least equivalent to MAT. That's clear, right? Okay. Now what is there on further? Let me add. Now book profit as per book is not the sufficient. It's not the conclusive. Okay. Book profit need to be adjusted. So if you read MAT provision, there are certain adjustments are given in section 115 JC. I think it is even in JC that you need to make adjustment. You need to make the adjustment to the net profit, and whatever profit is received, that profit is called your book profit. Okay, so I think I have tried to cover up all the points relating to MAT. Same way AMT is also there. AMT is going in the same line. Only difference is AMT is for non-corporate, MAT is for corporate. Okay, fine. Chaliye. If you have any question, then you can. Otherwise, we are going for the next topic. Okay. Shall we move to international taxation now? Sir, when MAT is higher than we also, yes, see one more thing, MAT is a tax. Okay, MAT is a tax. You need not to pay actually always. MAT is always adjusted against the advance tax, against the TDS, against the TCS if available, right? So it is not like that, yeah, you have to pay actually at the end of the year. No, no. MAT is like your normal tax. Only words is different and only calculations are different. That MAT you have to pay even though you are having a loss. Yes, but other way around, MAT is having a no differentiation with your regular tax. Yes, and it need to be paid by way of what? Advance tax, then this one TDS and TCS. And if it is short over there, but obvious, you need to pay self-assessment tax on that. Okay, going ahead. Okay, now talking about the international taxation. It sounds very good to listen. It's international taxation. Now, what is international taxation first? International taxation means whenever you come across with any of the provision, whenever you come across with any of the provision where you need to pay or you need to enter into a transaction of foreign territory, or we can say other than domestic territory. Is it okay? I am here in India. If I am providing services outside India, then I can say I need to check my international taxation. I am there in India, I am a resident in India, but for 1 month or 2 months, I have been to USA and I have generated some income. I need to check the provisions of that. Someone is there in USA, and he has made some investment in India. And some income is generated out of it. Yes, he needs to offer tax over here. Internet taxation will come into the play, right? Now, let us see first and foremost fundamental rule. First and fundamental rule stated in section 9 are there that in India, I think all of you have seen the table in the earlier stage of your intermediate, which says that number one, income received or receivable in India, or income received or deemed to be received in India. It's taxable for all kind of SSC. If you are resident, if you are non-resident, if you are resident but not ordinary resident, whatever may be your status, any income which is received or deemed to be received in India is taxable in India. I hope all you know this rule very well. Same way, second rule is there. Any income which accrues or arises, any income which accrues or arises in India or deemed to be accrued or arises in India is taxable in India irrespective of your residential status. Clear? Now try to apply your mind. Try to think twice that what could be the problem? Is it okay? What could be the problem? Now, what is the problem is, suppose in India, we are having a rule that any income which accrues or arises, what is the rule? Which accrues or arises from India is taxable in India. That's a one rule. Now, similarly, the same rule is there in USA. Suppose, I don't know about that, but just saying that if same rule is there in USA, they are also saying that if income accrues or arises in India, USA, it is taxable in USA. Any income which received or deemed to be received in USA, it is taxable in USA. Now try to see over here. I have one FD. One example I am giving so that you can understand what is the problem of international taxation and how we can solve it. I have a FD in India. I'm staying in US, I assume that. I have a FD in India on which interest is generated, and I have given a standing instruction. I have given a standing instruction to the bank that you have to pay this interest, to my bank account in USA, right? Because I need money over there. I don't need money here because I don't stay here. I'm staying there and my FD is here only. So what I have done, that my income is accruing in India. My income is accruing in India, but received in USA. Now, as I have said earlier, same rules are there in both the countries. One says income accrued arises in India, so taxable India. So Indian income taxator gave me the tax. At the same time, US government will also ask for the tax. Indian government and US government will also ask for the tax. Why? Because income is received or deemed to be received in USA. So now you need to answer, is it possible, is it fair, is it feasible, or it is good that I am taxes at both the places? No, answer is wrong. So what I can do? Is it okay? So what is the remedy available to me? So they are saying that in international taxation, Indian government has entered treaty. We are using the word treaty, or we can say double taxation avoidance agreement, DTAA, or we can say bilateral or unilateral reliefs can be done if it is not available. So one is what? All the countries, India has entered into treaty with majority of all the countries, that they have entered into treaty saying that ki, sir, if this is the situation, you deduct the tax. If this is the situation, you deduct the tax. Is it okay? So the person or the assessee will not face cash crunch at both the places. So that kind of agreements are done. That agreements are called DTAA, or we can say treaty. Is it okay? So this is that. Check. Now the situation may arise. That it's not possible that India is having a treaty with across all the world. No, chances are there that in some countries we do not have a treaty. In some companies we do not have a double taxation avoidance agreement. At that time, Indian income tax says that you will be given a relief. I don't know, it could be said somewhere in this line only, that you will be given relief, that whatever tax paid by you over there will be allowed as a relief. Is it clear? So this is the situation. I hope all of you are clear. What is the use of double taxation agreement? What is treaty and how need to be done? The things are that if you are generating income here or across the world, but nowhere you are subject to double tax. That is the thumb rule. Is it okay? Check. Going ahead. Now there is only one problem now. What is that? There is one problem now, that suppose, let us assume that I have gone to USA or I have gone to Australia and generated 5 lakh rupees income. Situation, I have gone to Australia, I have generated 5 lakh rupees income, and they have deducted my TDS. What they have done? They have deducted my TDS. Now they have deducted the TDS at the rate of 40% maybe. What is there on? They have deducted at the rate of 40%, because in Australia there could be the rate of 40%. So they have deducted. Now I am coming back to in India. I am a resident in India because I have gone just outside India just for 2 months. Now Indian government says that, sir, you have to pay the tax on this 5 lakh also. But I'm saying I already have paid a tax over there. So I say, let us find out the treaty over there. They are saying, no, we don't have treaty with that country, suppose. Then what can be done? So they will ask me the document of tax paid over there. Tax paid over there. And I can get a relief or we can say benefit of tax paid is available over here. Clear? Now very clearly try to remember this line forever if you want to learn international taxation. Relief is available. Relief is available to the extent rate prevailing in India. To the extent rate prevailing in India or rate at which you have offered the tax, whichever is less. Got the point? Repeating once again. The relief of double taxation is available as per the rate prevailing in India or tax deducted whichever is less. Meaning thereby, clearly listen it, that if I have generated 5 lakh in USA, there was a tax liability of 40%, they have deducted over there or I have paid over there. Now, if I'm coming in India and asking for a relief, I can get a relief maximum up to 30%. So I can't say that, ma'am or sir, I have paid 40%, now give me 40%. No, they are saying that what is our maximum rate? I'm saying 30. So they are going to give me the benefit equivalent to 30%. Clear? One answer. Now, second situation. I have gone to New Zealand. I have gone to New Zealand and generated 5 lakh rupees. I have gone to New Zealand and generated 5 lakh rupees as per the rule of accrual, where the income accrues or arises need to be paid a tax over there. So I have paid a tax over there, and there the rate of taxation is hardly 20%. What is the situation? The rate of taxation is hardly 20%. So they have deducted 20%. Further, they don't have treaty over here, assuming that they don't have a treaty with India. So both the countries are taxing. Now, while filing my return over here, what I'm saying is, ma'am, sir, my tax is already deducted over there. They are saying, okay, no problem, we'll give you the credit of that. Can you show the document of deduction of tax? I'm saying, yes, sir, I can show. So I'm showing all the documents. Fine, I'm showing all the documents that, sir, these are the documents available with me, and that can be done. Now, second point, they are saying that our tax rate is 30%. Our rate tax is 30%, and they have deducted 20%. So you are going to get benefit equivalent to 20% over here, and balance 10% I have to pay. Clear? Balance 10% I have to pay over here. So I would like to say that whenever you are having international transaction, you come across with the international transaction, the benefit is available, the credit is available, but subject to the rates prevailing in India or the rates you have already offered or paid over there, whichever is less. So you cannot enjoy a higher benefit. Got the point? So that is actually. So that is very important point that we need to keep in mind. They are using this word tax haven, or before that, let us have a glimpses of the index. Tax haven, CFC, residential. Okay, and then we are going to see this one, clearly arm's length price and method of international taxation. We are going to see in the detail. Okay. What is tax haven? Tax haven, as thing yesterday also we have discussed tax haven. If we are talking about internationally different meaning than locally different meaning. Tax haven locally, I can say SEZ units are sometimes we can say they are tax haven for us. As far as internationally things are there, I think yes, these are some of the examples are there. In USA, there is company called Delaware. In Wyoming, and some other countries are there in Europe, and this one is our hot favorite country, or rather I would like to say it was. I'm changing the word. It was a hot favorite destination for Indian investment, Mauritius. Now try to understand what was earlier. Now they have made some modification. So Mauritius is not now a favored destination for India. Earlier, see, I think everybody knows that in case of private limited company or in case of corporate SSC, company need to pay the taxes on what? Profits. They need to pay the taxes on dividend. They need to pay the taxes on dividend if amount is exceeding 10 lakh rupees. So 2-3 places there is a tax. So some companies, US companies are there, or Canadian company or London based company, they want to invest over here. So their problem is what? They are paying a higher tax because foreign companies are subject to higher rate of taxes of around 40%. So they are paying higher tax at 40. Dividends are distributed over here, so apparently not taxable over here. It is going to their own country, they are going to charge again. So what happens that while doing this kind of investment, they do not get this benefit of dividend tax twice. So what they do earlier, now it's not possible, or they have restricted it. Rather, I would like to use the word restriction rather than not possible. All the US based company, what they used to do, they open a company in Mauritius. US, they are opening one subsidiary company in Mauritius. Mauritius is opening a subsidiary company in India. Mauritius is just a corporate office or booking office, or rather I can use this word virtual office. No physical existence is there, but it is having a setup. Why they were doing like this? Because India and Mauritius had very nice treaty that any profit generated and transmitted over here, you are not going to tax. Here you are not going to tax. Capital gain exemptions. So many exemptions were available. So all the companies, what they used to do, they used to come through Mauritius. So they are living from their country, putting one leg in Mauritius and then second leg in India. So by doing this, they were making a so much tax benefit. See, again, it's a part of tax planning, and this one is illegal, right? Yes, one more thing I would like to add. Recently, we had last year, last year, we had opened one company in USA. We had opened a company in USA, and we have established a company in Delaware. Why we have established a company in Delaware? Because Delaware is a tax haven, it's a tax-free country, right? Singapore, yes, Singapore is again considered as a tax haven. The reason is it is having a cheapest tax rate in the world, that is around 15 to 17%, hardly. Dubai, I think everybody knows that Dubai is 100% tax-free country, but from the year 1/4/2018 probably, yes, from the year 1/1/2018, sorry, they follow calendar year. From 1st January 2018, they have introduced only VAT. Only VAT. So tax is there on goods, not on income. So again, Dubai is a hot favorite. Cape Town, it is there in Africa, and Nairobi, it is also there. These are some of the examples. You can have other those examples also, depending on your business to business. Fine. So this is that. Okay. Now, what is the problem over there with this kind of things? Whenever you start business in this kind of tax havens, we can say that no or nominal tax is there, no transparency, no exchange of information, and no presence. No presence means we can say virtual office. I hope everybody knows the word virtual office. Now, if you want to start a business in Singapore without going over there, without doing anything, you can go, you can means go online and you can have incorporation of your company within seconds. So that is that. No requirement of the substantial local presence. Yes. Methodology. Tax haven, how do you can do the business? Personal residency, asset holding, trading and other business activity, financial intermediates. Okay, and we are going ahead and concentrating for harmful tax practices. Okay, financial intermediaries. Now, what is there on financially intermediaries? Gift City is made for financial intermediaries. Gift City is made for financial institutes. Gift City is made for your back office operation mainly rather than the front office operations. So if some companies are there, actually I would like to say Bank of America is having a presence in Gift City. Which company? Bank of America is having a presence in Gift City. SBI is having a presence in Gift City. National Stock Exchange has also started some activities in Gift City. Why? Because they are dealing into financial transactions. Financial institutes are there. So if they do transaction in Gift City, they are subject to huge amount of tax benefits and incentives also. Why I'm using the word incentives? Because other than tax benefit, some transactions are done at a very nominal cost. So that can be done by this. Counteracting harmful tax practices. See, I think everybody knows Swiss bank. Yes or no? Everybody knows Swiss bank. That means if you open a bank account in Swiss bank, you need not to give your name, you need not to give your address, you need not to do anything. They are opening an account with a particular code and you can put any number of money. So what is there on? It's going to impact or going to start harmful, or we can say malified practices. Same way over here, if you see over here in tax haven, they have used this word, no transparency. So if I'm starting a business in Mauritius, if I'm starting a business in Delaware, then nobody knows my presence. They know by words, they know by code, or they may know by particular corporation IDs. So in long run, it's a harmful. At the same time, if you know the company law, they are using the word lifting of corporate veil. That kind of situation may sometimes arise over there. Controlled financial corporations. Now, what is controlled financial corporations? Now, as we have entered into the international transaction and gone through the basic detail, I would like to say or give some of the examples where we may come across with international taxation calculation. Number one, if you are doing import export. Number two, if you are having a branch or if you are having a subsidiary. If you are having a branch, if you are having a subsidiary, we can say that we are subject to international exposure. If you are taking a loan, sorry, from a foreign bank, yes, again you are subject to the international taxation. So there are certain transactions are there, foreign branch is there, foreign subsidiaries are there, then related parties are there, then you may come across with this kind of situation. So CFC also says that if you are having a subsidiary, that is nothing but your foreign corporation, then you need to check the residential status. I think everybody is aware that how to check the residential status of a company. How to check a residential of a company, residential status of a company. So we can say that management and control words are there. Yes or no? If management and control is situated outside India, yes, then they become a non-resident companies. So same way, we need to check the residential status and then accordingly we can go ahead. Resident of contracting state, double taxation relief, economic double taxation, and another word is they have given that how the judiciary things are there. Same income taxed in two or more country, but in the hands of different taxpayers. two or more states levy tax on same entity on same income for identical periods. Yes. Example, business profit and dividend in the different countries arises due to overlapping claims of tax jurisdiction. Tax treaties largely prevent or mitigate judicial double taxation. So here in this state, they want to say that in majority of the cases, DTAA prevails where double taxation could have been avoided, right? So that is the situation. Okay. Now there are 2 points are there. One is bilateral relief and unilateral relief. Bilateral means what? We are sitting together and saying that if I tax this, you don't tax that. If you tax that, we are not going to tax that. That is called bilateral. Both the parties are doing that, in which you enter into a method of giving the tax credit. Unilateral means we don't know that country, but you have been to there. We do not have relation with that country as an income tax, I'm saying. But yes, you already have paid a tax. If you have a proof, then we are going to give you the benefit. So that is called unilateral reliefs are there. Bilateral, yes, one method is exemption method. Exemption method says that if time permits and something is available, I will show you the book where DTAA provisions has been given, where they say that, sir, on dividend income, you tax income, we are not going to tax. In interest income, it is your bank, then you are going to charge tax, we are not going to charge tax. Same way, that kind of methodology is given. So that is called exemption method, where each and every item is specifically mentioned. Second method is credit method, where it is not feasible, where it is not easily available that yes, I am going to narrate all the story that dividend you pay, interest I pay, these and that. If it is not available, then they say, yes sir, if you deduct TDS, then I'm going to give a credit. If I deduct a TDS, you are going to give a credit of that. Clear? So this is that kind of adjustments are given and mechanism is clearly stated in the agreement. Yes, you can see over there in this type of relief, the mechanism for granting relief is provided in the agreement itself. So agreement says that yes, this is the method, this is the way you are going to get the benefit. Now unilateral benefit or unilateral relief. What is unilateral? Now unilateral means without considering, without talking with the opposite country, we are doing of our own. Why we are doing our of? Because our residents are generating income. Now one small line in between, is it good that our resident citizens or our SSCs are generating foreign income? Is it good or bad? If it is good, then I can say that yes. Why it is good? Because they are generating foreign currency for us, they are generating foreign remittance and their foreign currencies are generated, so it is good for us, right? Okay, one small aspect I would like to add over here. एक word है TRC. Have you heard the word? You can say at your place, I will hear, huh? TRC. Have you heard the word? TRP तो सुना होगा, टीवी में आता है. Same way, there is one certificate called tax resident certificate. What is the word? Tax resident certificate. Yes, all of you and also to the organizer also, just because of one limitation of the session, I could not show over here the TRC. TRC is a thing. आपको पहले summary बोल देता हूँ, then we are going with the TRC word. I cannot show being some client's data, as well as we are on a recorded platform. I am there in India. And someone is providing services to me from USA. I am there in India. Somebody is providing services to me from USA. So as a technical reason, I need to TDS. I need to deduct TDS from the payments made to him. But if he says, and if agreement permits, he says, sir, I am not having any residence in India. I am non-resident and I am providing you the TRC, tax resident certificate. I am going to pay the tax in my country. Then based on that agreement, based on that certificate of TRC, we can say that here Indian party, Indian SSC cannot deduct the tax and remit the amount and pay the amount outside India without deduction of the tax. Is it okay? Provided you must have that kind of data that he is non-resident, as well as we need to take his TRC. So it is not like that he is not paying tax anywhere. No. So TRC is a proof that he is a tax resident certificate, providing that I am paying all my taxes in USA. So please kindly do not deduct tax at India. So that kind of things can be done. Okay. चलिए आगे बढ़ते हैं. बिफोर दैट एक वर्ड याद आ गया मुझे. सेक्शन 40 क्लॉज ए क्या है? क्विकली कोई बोल सकता है तो दे कैन राइट समवेयर इन द चैट बॉक्स और लाइक दैट. What is section 40 clause A? Section 40 is talking about, section 40 is talking, 40 clause A is talking about situations, or I can say no, relatives payment is not there. Section 40 clause A, whenever we say clause A, it means yes, disallowed expenditure. It is in small letter. It says that if you have made any payment, without deduction of tax at source, then 30% of your expense. Earlier it was 100%. Now it is replaced with 30% of your expense is disallowed or considered as a non-allowable expense. Yes or no? So the section 40 clause A start with like this: notwithstanding anything contained in section 30 to 38, notwithstanding anything contained in section 30 to 38. If you fail to deduct tax, then we can say that the 30% is disallowed to you. Okay, coming back. So here I have said, if you have TRC, tax resident certificate, and you prove that, then even though TDS is required to be deducted, if you do not deduct TDS, yes, it's fine over there. Agreement with foreign countries, that is, we can say bilateral agreement. The central government may enter into agreement with the government or any other country outside India, specified territory outside India, for granting relief in respect of income on which have been paid both income tax and income tax under income tax in that country or specified territory, as the case may be. Income tax chargeable under the act and under corresponding law in force in that country or specified territory, as the case may be, to promote, what is the word, mutual economic relationship, trade and investment. So if Indian government is happy with some other governments and they make some trade negotiation, trade agreements, and by that virtue they are giving benefits. for the avoidance of double taxation of income under this act under corresponding force in that country or specified territory for exchange of information. This is very important. I think there is one small word you could have heard, or it may be there in this reference module also. FATCA law. नाम सुना है FATCA law? No. Okay, ठीक है. FATCA law is talking about specifically US only, US and India. They have entered into the mutual agreement of exchange of information, which says that US country says that if I have any people, staying in USA on a work visa, permanent visa, tourist visa, or whatever visa, we are going to share his income details to you. At the same time, if your means our citizens or our people are staying over there, or your people are staying over there, we should exchange the information. We should exchange the information under this law. Now, what is the problem? Try to see over here. A person who is staying in USA, since last 10 years, who is now a US citizen, who is a resident of USA and non-resident over here. But he is having one small house over here. He is having a house in India from which rent is coming out. Rent income is generated, and what he do, he is not coming in India, but what he can do is he is doing from the communication by way of mail or WhatsApp or by telephonic way, he is giving that house on a rental basis to someone and says that you need to deposit rent in this account. What they need to do? They need to deposit rent in my particular account. Now the account is here that in India, the amount is not that much big so that income tax will comes to know, yes, there is amount. At the same time in USA, he is not showing that income. So what he is doing is trying to evade or avoid. Is trying to evade or avoid the income tax in either of the countries. So now due to exchange of information, I think we have seen in the first session, that is 2 days back, that if you are having an asset outside India, same way US people will say, FATCA law says that if you are having any financial interest, outside USA, you need to report us. So what the person will do, the person who is there in USA will write, sir, I have a house in India. What Indian government will do, Indian government may cross verify and confirm, yes, house is there, income is generated, verify, is he paying tax over there? Then same way, the person is there having 10-20,000 shares or number of shares over here in India. Demat account is there in India, he is not showing in USA. Indian government will say, sir, we have one fellow with this demat account having X amount of shares. Check that. Does he have shown over there? So this is called exchange of information. That's a problematic. For whom? Problematic for those people who is trying to evade or avoid the taxes. So that kind of agreements can be done between the countries. Next one, for recovery of income tax under this act and under any correspondence law force in that country or specified territory as the case may be. Very good word is there. Nirav Modi. I think everybody knows. Suppose there is one person by whom some tax is payable. I'm not talking about that, but Nirav Modi in relation to bank loan or these or that. I'm just talking about, say for example, there is some tax liability payable by him. There is some tax liability payable by him in India. Now he has left the country and staying in UK. Now what double agreement or bilateral agreement will do? Whenever the Nirav Modi is going to file his return that XYZ is my income, that government can freeze, can say that no, you have some pending litigation, you have some pending amount payable in India also. So by bilateral agreements, you can also catch defaulter who have left the country and settled in any other place outside India. And for that, I would like to just add over here, for that, government is trying very hard to link, government is very hard to link Aadhaar card, PAN card, your passport, your biometrics data, so that you are traceable wherever you go. Is it clear? You are traceable wherever you go. It's like that. Sure. And may make provision as may be necessary for implementation of the agreement. Yes, notes are there. I think everybody knows GAR. It has been, I think, delayed for some period of time as of now. Okay, yes. एक case याद रखना. This one is that what is stated highlighted. Okay. Someone has asked a question, sir, if we have this type of laws, why Nirav Modi has did so? Okay. See, one more thing, just to have a discussion outside this law. We have a law, right or wrong? We have a law. We may have the agreement. We don't know that with UK it is there or not there, but there are different people are there. If you're listening or reading newspaper or watching in TV, then you know that in China, you cannot do dharna and this kind of exhibition, and really it's illegal. If you want to do any activity against the government, it is considered as illegal and you are subject to the jail or imprisonment. As far as India is there, it's legal, and if you write to the police, they will give you the protection that yes, I want to do dharna, I want to do fast and this kind of things. So every law is having a different treatment for the citizen. So we have agreement, yes, it is there, but also implementation of that agreement takes some time. And another thing, yes, those people who are living from X country to Y country or Y to Z, they are preferring that country. See, they are preferring that country which law or which agreement are favorable to that fellow. So they are not going to stay in that country which is against of the law. So they have done all the analysis that in case anything happens, in case this kind of situation arises, then I must have a place, safe place where my interest is followed, right? Yes. Now see this question. If no tax liability is imposed under this act, question of relief does not arises. What is there on? If there is one income, let us see one good example. Probably it can be asked because it has been asked number of times based on Azadi Bachao Andolan Supreme Court judgment 2003 case is there. Which case says that, and let us take one example. I have gone to outside India, say for example in Britain or in Germany, and I have done farming for 2 months. What I have done? I have done farming over there. I have generated agriculture income over there. In 2 months, I have generated, suppose in Indian terms, 10 lakh rupees. I have generated 10 lakh by way of agriculture income. In Germany, assuming that the income is not exempt, so what they have done, they have deducted tax on that source. They have deducted 30% on that. So out of 10 lakh rupees, I have already paid 3 lakh as a tax and 7 lakh I have received as an income. Clear? So that is the situation. So my 7 lakh rupees is my income. Now I am coming to India. Now I have come to India and saying that, sir, my 3 lakh rupees, my 3 lakh rupees tax has been deducted. My 3 lakh rupees tax has been deducted. Give me a relief. Then this clause says that if no tax liability is imposed under this act, then question of relief does not arise. It means in India, agriculture income is not subject to tax. Agriculture income is not subject to tax. So here there is no tax, so no question of relief will arise. Got the one? So that is very important judgment and frequently asked. Yes, they are saying that yes, proof need to be provided. Yes, it's very clear. You have to provide the proof. Questions are there. Okay, just to have clarity, let me see one question only. Mr. Ramesh, a resident Indian, has derived the following income for the previous year relevant to assessment year 2021. Income from profession in India 2,44,000. Income from a profession in country A, tax paid in that country at the rate of 5%, 4,50,000. Compute Indian taxable income, assuming that as per the treaty, क्या word use कर रहे हैं? Treaty, or we can use the word DTAA, between India and that country A, 4,50,000 is taxable in India. So they have treaty that it is taxable in India, not taxable in their country. If it is ruled that it is taxable in that country, then we need not to do anything over here. However, foreign tax can be set off against the Indian tax liability. Yes, it's possible. So how we are going to do the calculation? See from here, income from in India 2,44,000. Income from a profession outside India in country A 694. Total no deduction, so total income is 694. Assuming that I think yes, Mr. Ramesh is there, so individual tax rate will applicable, and tax liability on that is 51,300, along with says and everything, the tax liability is 53,352. Now relief is available. Relief is available under section 90. At which percentage? 5%, 22,500. Are you clear? So that relief is available, and balance amount they can pay as an Indian tax. Provided rules are there. Again, I'm repeating, there must be a treaty. In treaty, it is said that yes, it is taxable in India. If it is written taxable in A, so we are not going to tax. At the same time, the rate proof must be given that 5% has been deducted. Clear? Now, if the rate is more than 5%, instead of 5%, if the TDS has been deducted at the rate of 25 or 30%, then we could have received, we could give them benefit equivalent to average rate of our country, whichever is less. We cannot pay higher rate. Clear? Let's see if we have any example of higher tax. Yes, this one is example. Let us see over here quickly. Sri Arjun, an ordinary resident in India, provided the following income for the previous year relevant to assessment year 2021. Income from India. I hope all of you are fine as I'm going this way and very fast also. Okay. Income from India 340. Income from countries at 2 lakh rupees. Investment in PPF 10,000. Further, it is to be noted that yes, these are the things relating to the treaty. India has avoidance double taxation agreement with country Z, and according to that agreement, income is taxable in the country in which earned and not in any other country. However, in other countries, such income can be included for the purpose of computation of tax rate. So tax कौन से rate country में लगाना है? वो ही country में. Foreign income has been taxed in country Z at the rate of 20. Now see over here what we are going to do. Income from India 3,40,000. Income from country Z 2 lakh. Total income 5,40,000. Everybody knows ATC PPF investment is there, so deduction is available. So my income is 5,30,000. Now on this 5,30,000, my tax liability as I have calculated is 19,240. What is my tax liability? My tax liability is 19,240. Now, am I eligible for the relief? The answer is yes. Answer is yes. Now, what is relief is available? He has offered 20% tax. How much? He has offered 20% tax in his country. But as far as I am concerned, if you see the first example, the rate was 5 only. So we have taken full exemption. Now the rate is 20% over there. So I have said that what is the rate we need to calculate? We need to calculate a rate prevailing in India or that which less. Now how to calculate our rate? If I say for a company, yes, we know the rate flat 25%, 30% as the case may be. If a partnership firm, yes, 30% flat rate is there, we need not to worry. But if I'm talking about individual, then we have different rate 0, 5, 20, 30, right? So how to know that? So we need to do it average. So what we have done, you can see over here, total tax payable 19,240, total tax payable 19,240 divided by my income 5,30,000. So my average rate is 3.63. What is my average rate? My average rate is 3.63, and that percentage is allowed as a deduction on that income. I hope it's clear. So we have seen two examples. One is talking about lower rate, second one is about a higher rate, and we have made a net of. Sure. Adoption by the central government of agreements between this, yes, it's a procedure has been given that how we are going to adopt this kind of rates over there. Countries with which no rate agreement is available. If no rate is available, we can go with section 91 unilateral relief. अपने हिसाब से दे सकते हैं. Okay, some examples has been given. I am not going to touch upon all the examples. Foreign tax credit. Now, I think one problem is always arising between the India and other countries. There is always one problem arises between India and other countries. What is the problem? Problem number one is we follow April to March year. We follow April to March year while foreign countries follow January to December. So the situation may be go wrong that if we are having a tax year in 2018 and 2019, so what we need to do, we need to take a proportionate tax liability accordingly. Let us see one by one which are the foreign tax credit rules accordingly. SSC being a resident shall be allowed a credit of the amount of any foreign tax paid by him in a country or specified territory clearly outside India to the extent specified in this rule. More than 1 year if the benefit is available for more than 1 year. Example, as I have said, in USA calendar year is there 2019. What you will do? We can say that we need to bifurcate some period in the year 1819 and some period in the year 1920. No credit of interest. The credit shall be available against the amount of tax, surcharge, and cess payable under the Act, but not in respect of sum payable by interest, fees, or penalty. So you cannot take a benefit if they have paid late fee interest, if they have paid penalties in that country. Only tax liability can be taken over there. No tax credit, no credit for disputed tax. If there is a dispute in that country only. What is dispute? I think last session I have shown you that assessment order under 143.3, you have gone into the dispute. Clear? Repeating once again, there is one order has received in USA. And what the order says? The order says that you have to pay $3 lakh as a tax. But you have not agreed and you have gone to appeal because in After order of income tax officer, you can go into the appeal. So you have gone to the appeal. Now I can say that that tax of 3 lakh rupees, if you have paid or not, what is the word? If you have paid or not, but the title of the tax is a disputed tax. So if the tax liability is disputed, then the credit of that cannot be claimed. You can claim the credit as and when the dispute is over. Meaning of foreign tax, let us understand. A country or specified territory which India has entered into agreement, tax covered under the said agreement, whatever said in that agreement. Any other country specified tax payable under the law of that country or specified territory in the nature of income tax referred in 91. Income tax means here whatever things are liable to tax, we are going to see in that fashion only. Let me add one word here. We do not have agreement with that. As I have explained for agriculture, same way I'm explaining. In India, your dividend income is exempt. In Canada, dividend income is not exempt. So they are subject to tax. In Canada, you are generating dividend income and tax has been reduced or tax has been deducted. That credit is not available over here. Why? Because in India, that income is exempt. Second situation, capital gain. Capital gain in India, I'm talking about long-term capital gain in India is subject to flat tax rate of 20%. Clear? In India, capital gain is subject to flat tax rate of 20%. In USA or in any other country, if it is subject to 10%, credit is available only to the extent of 10%. So here, whenever we do not have agreement, we have to go by income tax only. So assuming that it is our income, it could be the income of India and how it could be treated, that kind of things you need to see over there. Other thing need not to see. Next one, documents required. Give me a minute, then we'll starting documents required. Yes. All of you can view the book over here. This one is foreign direct investment in India. Book is there. In that, FDI policy and everything is stated. In that, I'm going to show you only those parts that is talking about DTAA. Okay, I thought another book is there, but this book is also covering those aspects. That's calculation of this one, we can say FDI, and how we can go for DTAA. So that I'm going to show later on if available. This one is a different book, but it is relating to the FDI. So what the rule says again and again, you must have document. That's the first story, right? At the same time, if you have agreement, then go with the agreement. If you do not have agreement, then you can go with what? Rules, as if the income is generated in India. Next one, very good word is there, very important, PE. What is PE? We are having two words now. One is resident, another one is a PE. PE means permanent establishment. This word is used. See, generally India contacts the term permanent establishment means fixed place of, what is the word? Business, through which the business of an enterprise is wholly or partially carried out. So we are saying that for taxability in India, we must have a PE in India. PE means permanent establishment, and permanent establishment means what? A place of management, where the management stays, where the management lies. So if management is there in India, then income is taxable in India. Branch in India, yes. Office in India, factory, sales office, warehouse, farm, plantation premises used such as a sales outlet, then we can say that that company is having permanent establishment in India. So there are a number of taxation calculations are there based on your PE. If you have PE, well and good. If you don't have PE, then the income is taxable in the place where you are actually situated. Now coming to one more example. As I said just before, that I am taking some services, or let me give an example of this Microsoft. I think everybody knows Microsoft very well. If Microsoft is not there, I think so many things not could be possible, like a Word, Excel, MS Office. We have operating system. All the things is done just because of the OS over there. Now, I have one client in India, in Ahmedabad. They want Microsoft license. You need to take a Microsoft license. Now, Microsoft license, that means you can say Hotmail mail ID or 365 subscription if you want, you have to buy from. I think all of you could have free mail ID of Gmail or Hotmail or Yahoo Mail or any other mail IDs could be there free of cost. If you want to buy for your organization with your name, example is my ID is parag@paragsoni.com. My personal mail ID is parag@paragsoni.com. So nobody knows that Parag Soni is using Gmail, Hotmail, Microsoft, Zoho Mail, or any other mail. So I'm having our own domain is there. So now to buy this domain, what you need to do? To buy this domain, what you need to do? That I need to approach to that company. I'm calling to company or sending a mail to the company to Microsoft, sir, we need 35 email ID, customized email ID with OneDrive capacity of 15 GB, one mail capacity of this, we want this, and they are saying yes. All the things are available at $10 per month per user. I agreed. Now, when I'm making a payment, very important thing, when I'm making a payment, I'm paying outside India. Suppose if they don't have PE in India, I'm making a payment outside India. Now, if they don't have PE in India, they can request me, they can give me the content that don't deduct TDS. I'm giving you my permanent establishment in UK. I'm giving my TRC of USA, and we do not have any establishment. We do not have any PE in India. So don't deduct the tax. Yes, if they say I need not to deduct the tax. Got the point? But the point when they start one branch, why they are starting a branch as a back office, a sales office, a support office, whatever they are. Or if they have management over here, we can say that they have PE in India and income is generated in India. Nowadays, all the big companies like Google, like Microsoft, all are having branches in India, having PE in India, and they are paying a tax generated out of India. So the PE is playing an extreme important role while deciding some tax is payable here or not. In reference book, we are going to get huge amount of case studies on PE. Taxation of business process outsourcing in India. I think everybody knows BPO, outsourcing, so many things are there. So one need to decide the PE, as I have said, we need to decide the PE of Singapore company. Microsoft company was earlier situated in Singapore. Recently, since last 2 years, they have started the branch in India also. Right? Okay, I think this we already have seen. income from an air shipping transport under DTAA. I think in the previous session we have said that we have said that that US Air Company, US Airlines is coming to India. US Airline is coming to India and taking some passengers, taking data, sorry, taking goods, taking mails from India to outside India. They do not have their own airport over here, so they are using on shared basis. Shipping companies, same way they are using the port on a shared basis or some commission basis or payment basis. Then there is a clear-cut presumptive incomes are there that if an non-resident shipping company generating income from India, 5% or 10% flat they have to offer as a tax. 5% to 10% they have to offer as a tax effect like this. Same way for airlines also, it is 10 or 5% that they have to pay on a presumptive basis. No expense calculation, nothing is required. If they want to show lower rate, also they are not eligible. Clear? So that is presumptive basis taxations are there for shipping and air company under DTAA. DTAA OECD model can be followed. So that is that. Fine. Next one. So this is the way how we can use their territory and they are using our territory. For this purpose, that is for air and shipping, there are same two words are there as I have discussed. Any income accrues or rises in India or taxable in India. Any income received or deemed to be received in India is taxable in India. Both the conditions apply for this too also. Let us try to understand the statements right now. Non-resident shipping company need to offer 5% or 10%, please do confirm, 5% or 10% off, 5 or 10% off what? Two things. Any passengers, goods, mail or livestock generated or so we can say aboard from Indian airport or Indian port. From any Indian port, if any passenger is sitting, if any goods are going, if any livestock is traveling, then whatever income is generated from India, it is taxable in India at the rate of 10%. Same way it's possible that a person who is there in USA, but paying money in India, to whom? Non-resident only. So they are saying that non-resident shipping company need to offer 5 or 10% of amount received or receivable in India from the carriage of the passenger, goods or livestock as the case may be. So we are going to follow two things. Whatever is accrued from Indian port or Indian airports, yes, taxable India. Whatever received from India, again it's taxable. Fine. So that's that. That's basic we have discussed. Now coming with a very important word with number of methods, we have transfer pricing. What is transfer pricing? Before going to transfer pricing, let me ask one section 40A subsection 2. Section 40A subsection 2. I hope you have the idea of section 40A2. Anybody is having idea? If you have, then well and good. If you don't, just try to listen it me carefully. Yes, see over here. First question. Okay, we have just discussed so many things. Let me have one quickly question answer round now. Yes, Amit has rightly said payment to relatives. Now I have one question. Mr. X is having own business, Divine Reality. He is having a proprietorship business with the name Divine Reality. Now he wants to pay to his father. He wants to pay salary to his father. Amount is 50,000 per month. Now my question is it allowable or not allowable? Mr. X is the owner of a firm called Divine Reality, a proprietorship firm, and he has paid 50,000 per month to his father. Is it allowable or not? Only this much data is available. Take a note, those who are saying no, like I think Nirmala Panchal has said no. Ensure that those who are saying if paid, Mukul Soni is saying if qualification this, that, ignore it, all the things. Only this much amount of data is available. That's it. If this much amount of data is available, the answer says yes, allowable, because just by using the word father doesn't have any negative impact, and you can't say that it is disallowable. If I say father, brother, sister, spouse, any relatives are there, no, it's not allowable. It is disallowable if I write that reasonable value is 20,000. Are you clear? If I write the word reasonable value is 20,000, then 30,000 is disallowable, or other way around, 20 is allowable. If I'm not using this word reasonable, but I'm saying that he is not attending the office, or in other way around, he is not doing any work, I can say full 50,000 is disallowable. Are you clear? So why people do like this? Why people are doing like this, that they are making a payment to relative? The answer of the same goes like this, that if they want to avoid the tax, if they want to avoid the tax by using evasion method. What is the method? Evasion or avoidance method, because this is the bending of the law. I'm paying 50,000 per month to my father. Eventually it becomes 6 lakh annually. He is having investment in ATC 1 lakh rupees or 120. So his big income become 4,80,000, and you know it very well that on 4,80,000 there will be no tax. Yes or no? If you see on the other hand side, I have paid 6 lakh rupees to my father, and my business is having a higher income, so I have saved 1,80,000. So just by doing this kind of transaction, I have saved 180. What I have done, I just have paid to my father and I could save 1,80,000. So this is avoidance of the law. But apparently it is available like this, but it is avoidance of the law. Now, this transaction, why I have discussed 48.2? Why I have discussed 48.2? Because we want to go with TP, transfer pricing. 48.2 is talking about local transaction. They are talking about your business and also international business. So same way, now try to see over here. Mr. X is doing business in India, and his brother, Mr. Y, who is doing a business in Dubai. Are you clear? There are two fellows are there. One, try to understand why we wish to go with TP. One person is there in India, one person is there in Dubai. They have sales purchase transaction with each other, right? Sales and purchase transactions are there with each other, as well as they are doing common business also. In India, the tax rate is 50%. In Dubai, the tax rate is 0%. Now, as you know it very well, they are brother. I have said the word brother, they are relative. If you want to say company as a relative, then we can say holding and subsidiary, associated enterprise, branch, joint venture, yes or no? So this kind of different words can be used for it. So in this situation, what I need to do, I should make more profit with Mr. Y or Mr. X. Mr. Y, yes or no? So what is the situation? Try to see over here. I'm just trying to draw something. My handwritings are too poor, but just trying to write over here. Whenever Mr. X is going to make some sales to a person in Dubai as a purchase, what he will do is going to do it with minimum value. What he's going to do is going to sell with a minimum value, so that here his purchases are there with minimum value. He sells to third party with a higher value, so high profit will be booked over here, having zero tax liability. Got the point? So some people do this kind of transaction, and to avoid it, the government says, or income tax says, that if you are having related party transaction, here I have said only X and Y both are relative. Other than that, you can have this kind of relation. If you are having related party, then what you need to do, you have to do the business with reasonable price. Yes or no? Reasonable price, and reasonable price means we have one identical word, arm's length price. Arm's length price means transaction made with third party, unknown party. Clear? So that kind of things, basic stories there. Now let us go with the transfer pricing. I hope all of you are clear with the basics. Okay, why we want to do TP. This is all stories there. Associated enterprise, yes, you can see which kind of transaction can be there. Transaction can be of a goods, transaction can be of services, transaction can be of their intangibles, loans and guarantees. So this kind of transactions can be there, and they are saying that section 92 says that even arm's length price need to be applicable or need to be evoked. The section says that if there is an international transaction, first word is very clear, when there is an international transaction done between the related parties. Now related party, they are, instead of related party, they are using the word associated enterprise. If there is an international transaction entered between the associated enterprise, then it must be at arm's length price. What is that? It must be at arm's length price. And if it is not as per the arm's length price, then income tax department will calculate arm's length price, and difference of it will be added as your income. Here, repeating once again, whenever you enter into an international transaction, whenever you enter into an international transaction and it is with associated enterprise, then it must be at arm's length price. If it is not done at arm's length price, then income tax department will calculate arm's length price, and that will increase your income. Clear? Yes. All of you, please note over here, try to see over here, very conservative answer or very different kind of logic I am going to give. Logically wrong, but practically right. Is it okay? Repeating once again, logically wrong, but practically right. Income tax says that transfer pricing, whenever you are going to apply the transfer pricing rules, whenever you are going to apply the transfer pricing rules, and if there is increase in the income, what is the word? If there is increase in the income, if there is decrease in the expenses. Other way I would like to say, if there is increase in the tax liability, then TP methods are applicable. And they are going to say that yes, we want to make correction as per TP. But if by applying arm's length price, your income is coming down or your expense is going up, at that time, income tax will put themselves in a control and say no adjustment required to be made. Are you clear? Again saying, are you clear? Take a note of this. Whenever you do any method of arm's length price, and if your answer goes negative, negative means reduction of income, claiming of higher amount of expense or reduction of taxes, then you need to write your answer like this: as by applying transfer pricing method, income is increased, so no adjustment need to be made. Reverse situation, if there is increase in the income, yes, you are going to use this word yes. By applying arm's length price this method, our profit will be increased or decreased by increased by this way. For decrease, never do any adjustment. Take a note of that. In examination, you may say plus or minus. No, only plus is allowable, minus is not enabled. So that is the biggest differential or logic differential values are there in arm's length. Okay, I think they are trying to give an example. You have sold at a lower rate, higher rate. Some examples has been given. Now, what is arm's length price? Okay, before going to arm's length price, there must be one case or there must be one definition which is talking about to whom we can say associated enterprise, right? So there is a long definition available over there that these two fellows are said to be associated enterprise. Now let's see what is arm's length price. Arm's length price is a price which applied or proposed to be applied in a transaction between person other than associated enterprise. That means unrelated person, resident or non-resident. Second, in uncontrolled condition. Uncontrolled condition means you are not under the obligation of someone else, or you are not independent. Uncontrolled means you are dependent and you are free to decide or take a call for X, Y, or Z value. Example, I am a chartered accountant doing practice, and my father is coming to me and ask me, what is the price of filing return? What is the price of filing the return? I am under uncontrolled, not uncontrolled condition. I am in controlled condition. I cannot say more than X, Y value, or rather, I would like to say I cannot charge at all, right? But if someone says, if anyone unknown person is coming to me and asking for a price, I can review the document and I can say that I'm going to charge 10,000. So what is there on? Arm's length price means a price where you are charging, where you are entering into transaction, where you are doing a deal, uncontrolled situation, not related party, no pressure is there. Is it okay? So that price is called arm's length price. Process, what is the process? I think I'm not going in much detail of the process. Comparability analysis, characteristic of the property or services, functional analysis, contractual terms, market condition. Market can be geographical, government rules and regulation. Yes, I think this one like to add something. What is government rules and regulation? Government rules and regulation means if there is MSP. I think during lockdown you could have heard this word MSP many times. MSP means maximum selling price. Government decides some price, this is the bottom price at which I'm going to collect it. right? So that is called, some government regulations are there, then you cannot do anything over there. Other market condition. Next one is business strategy. So that's also going to make a good role over there. Transaction analysis, evaluation, and separate combined transaction. Okay, now this one is also good in relation to arm's length price. If someone say, if someone says me to quote for audit fee, then I may say X value. Yes, if someone is asking me that quote for audit fee, then I may say yes, X, Y, or Z values there. But if someone is saying that, sir, quote for an audit, quote for an income tax, quote for accounts, quote for this, and all together package, then different story. So whenever we are going to see the arm's length price, we need to see in relation to this aspect also, that we have to cover a group or separate deal. Yes, word used over here, package deals. I think everybody knows package is always cheaper. Yes or no? Use of arm's length, right? Okay, now what is range? See, one more thing, if you go anywhere, if you go any market, then 2% to 5% variation is very common. There is 2% to 5% variation is very common. So what we need to do is, if you are having any arm's length price, then income tax is going to give you the range that percentage of 5% variation plus or minus is considered as allowed. Is it okay? So we are not going to stick to exact value. We are going to stick to some minor variation that can be 5 to 10%. Okay, so that is that. Use of multiple years data. Yes, I think everybody knows that if you see 2020's data, then answer will be extremely different. If you say 2019's data, then answer will be different. So what we need to conclude, that we need to see that we have to take data in relation to the averaging of that. Clear? We have to take a data in relation to averaging of that. Next one, international setup. हमने एक फोन कर लेते हैं, बात कर लीजिए. International setup. Now what is international setup? That we are going to learn one by one in different aspects. International setup means what? In India we may not be charging for the delivery cost. In some other country they may be charging for the delivery cost. In India there may be some higher amount of taxes are there, tax on tax can be there. Here or in another country tax cannot be done. So if you want to do some comparable study, that what is charged by IBM in India and IBM in USA, then you have to remove that international set off. Example is laptops. Let me give one example. I am having this laptop purchased from HP. What is that? This laptop is having purchased from Hewlett Packard. HP laptop is there with Indian warranty. What is the word? Indian warranty. That they are giving me the warranty of 2 years. Anything happens, we'll replace it. Now, if I want to check the corresponding transaction internationally, that one is selling to me in India with Indian warranty. If one person is selling in USA with worldwide warranty, then I can say that both price are not same. If you want to make a same, we want to remove the warranty cost from the same. Otherwise, HP over here with local warranty, HP over there with worldwide warranty, are not comparable. So what we need to do whenever we want to do TP or arm's length price calculation, we need to remove all the international set of all the adjustments that we need to do at the time of adjusting international data. Are you clear? So that is that. Use of custom valuations. Yes, we have might be trade and tariff agreements. I think everybody knows that. All of you might be aware that if I'm going to buy a car from India and same car if I'm going to buy in foreign country, both are having different values. Both are having different values. Then what I need to do? I need to use custom valuation like WTO. Their import duties are there, that can be taken care of. That use of transfer pricing methods. Yes, we are going to have number of methods that we are going to see one by one later on today. Yes, all of you are clear what we have discussed. I think sounds very lengthy as well as tricky also. So what is there on what we have seen where TP is applicable? Starting from here, what is TP is there? TP, we need to be clear, international transaction, one part. Second, transaction made between the related parties. Third and foremost important part. Third and foremost important part is that we have to take into consideration, we have to take into effect if due to arm's length price calculation there is increase in the value of tax liability. If there is a reduction, then no TP cannot be. One, we have seen arm's length price, which are the points that need to be taken into consideration while deciding your ALP. Next one, same way, we are going to have now enterprises. They have used this word enterprises. We are going to later on have the word associated enterprises. So ignoring the enterprises, those who deal in goods, those who deal in know-how, patents, copyrights, so on and so forth. Small question to keep you all alive. What is know-how? Quickly. Yes, all of you. What is know-how? Technology information provided, right? Know-how means technological information, knowledge, some formulas are known as a know-how. They are part and parcel of the intangible assets. And under data documentation, drawing, specification relating to any patents, copyright, yes. If you enter into this all transactions, you are said to be an enterprise, and later on there will be something called associated enterprise. Meaning of international transaction. Now what is international transaction? They are saying that when there is a movement of the goods from one country to another country, or rather I would like to say they could have given the definition somewhere in the Income Tax Act. They are saying that bringing of the goods or going of the goods outside Indian territory to territory other than Indian territory. Definitions are like this: bringing or fetching the goods from Indian territory से कोई goods जा रहा है to another territory other than Indian territory, then it is said to be your export. Same way, what is import? They are saying that the bringing of the goods from a territory other than Indian territory to Indian territory. Why they are giving this kind of awkward definition, I would like to add why they are giving this kind of awkward definition, because they want to be very clear. That's the first part. In second part, in some of the countries like Nepal, it happens that some goods are going from Indian territory They are crossing Nepal and they are coming back to the India only. So if they want to be in India, they have to cross the international territory sometimes. Then it cannot be said to be export, because ultimately goods are falling. Goods are falling in where? India. So it is that. Fine. So these are some international transactions are there. Yes, you can view over here. A company on the related party, yes, outside India, yes. I think all of you are aware about this all stories, so not going in that much detail. Deemed international transactions, yes. Meaning of specified domain, yes. चलिए, okay, यहाँ तक limit करते हैं. Let us limit ourselves up to this. After this, after the ALP, arm's length price and calculation, the income tax department has also incorporated the provisions of this arm's length price for specified domestic transactions also, right? Not international, domestic transaction also they have specified. So I'm not going into that, but we are going to just look at right now of international transactions. Okay, check. Now let us see computation of arm's length price. That's very important, and I think all of you are aware that there are certain methods are there to calculate the same. How to calculate arm's length price? It's a very complicated as well as things which require huge application of knowledge of a particular method as well as of the business is available to you. Number one, transaction based method, and second one is a profit based. One is what? Transaction based method. Another one is a profit based method. Transaction based method means comparable uncontrolled price method. It is also known as a cup price. Next one is resale price method, and another one method is called cost plus price method, CPM. So cup, RPM and CPM are there. They are based on the transaction. Another one is a profit split method, transactional net margin method, and last one is nobody knows. Last method nobody knows, which says that such any other method which may be prescribed by the board. So if board thinks that yes, in this odd situation, in this current scenario, no method is viable, we should deploy or we should apply this different method. Yes, you can apply that method also. Yes, you can see over here where you think that more than one method is applicable. If you think that yes, resale price method may be lagega, profit split is also applicable to this, then what you need to do, you need to apply most appropriate method out of two. Clear? Sure. Now, starting with first method, okay, they have not given details of much method. Let us see first method, that is called comparable uncontrolled price method. Now, what is comparable uncontrolled price method? Comparable uncontrolled price method means method where a person is selling to some other person. A person is selling to some other person. That is called comparable uncontrolled price method. Fine, simple hai? Check. Apparently sounds simple. Let us make it complicated. Mr. X, Indian, let us make it a company. Indian company is doing business with USA as well as they are doing business with Germany, right? They are doing business with USA as well as Germany. They are into the, I can say, AC sales, air conditioner sales are there. So they are doing like this. US company, they are selling to Y company, where this both company, X and Y company, are having interholding percentage of 30%. So if you read the associated enterprise, they are saying that if a company is having more than 26% of the capital in another company, they are said to be associated enterprise, or I can say that it's a holding company or something. Then X and Y become related party. Now company is Germany is an unknown party. We can say uncontrolled parties, right? Uncontrolled parties. Now, X company has sold 10,000 AC to Y company at the rate of, for simplicity, I'm writing small value, 25 per AC. Same way, they have sold over here 5,000 or make it 500 AC at the rate of, suppose 20. Is it okay? Now, income tax has asked why you are charging 25 and this. So I feel it that make it 30. So make it simple. 30. Why you are selling to Y company at a 25 price? So why what they want to do? Income tax department wants to apply transfer pricing method of uncontrolled price method, and they want to say that why not your income can be increased at the rate of 5 rupee per unit. Right or wrong? I hope we'll agree that in this situation, income of X company, Indian company, will increase by 5 rupees per unit over here. And accordingly, your income will be increased by 50,000. So you have to pay tax on this additional value by applying TP method. Is it okay? Extremely simple example. But SSCs are not that much simple. They are saying, sir, you are wrong. What they are saying? Sir, you are wrong. They are saying, what is the wrong? They are saying that Y company is giving bulk order. What is the situation? Y company is giving a bulk order and 2 rupee per unit is discount for it. Y company does not require warranty. Does not require warranty, while we need to give warranty to the Germany company where the cost is 1 rupee per unit. Y company does not require, I think everybody knows CIF and FOB. Yes or no? This kind of agreements are there. So under CIF agreement or FOB agreement, there can be different cost. Suppose in USA, all the insurance cost freight is borne by whom? US company, which is 0.75 paisa per unit, while in Germany we have to provide all the cost, insurance and freight up to their doorstep. Is it okay? So this is the situation. So now we can't do this one. We cannot directly add 5 rupees over there. We need to make a recalculation. What is recalculation? Recalculation says uncontrolled comparable price. What is that price? It is 30 rupees. Now we need to add, we need to less something. Okay. Now what is there? Y company is giving a bulk order, so that we have given a discount of this. So to match it, we have to reduce 2 rupees. Next, Y company does not require warranty, while this company is required. So that price is higher by 1 rupees. Next one, this one, CIF, Y company is going to bear all the cost, while this company is not going to bear. So we have added. Everything is there in list. So let me add something. Y company need packing, which is not required by Germany, and cost is 1 rupee per unit. So what they need to add? They need to add packing cost 1 rupee. Now whatever is the answer is my final arm's length price. Now what is arm's length price? 30 minus 2 minus 1, 27, plus 1, 28. So 28 point, I hope I'm right, 28.75. 28.75 or 27.75, whatever they are on, ignore right now. 27.75 is my arm's length price. Now income tax will say, sir, what is your arm's length price? You are saying 25. So what they are going to do, you have charged less 275 at the rate 10,000 units. So this amount need to be added in your taxable income. Are you clear, all of you? What they need to do, this amount will be added to your income under these calculations. Now second point, let us assume something different. Suppose Y is giving a bulk order and the cost of that is 4 rupee per unit. Assume that 4 rupee per unit, and while doing all this calculation your answer goes, suppose 23.75. What is there? Your answer goes arm's length price 23.75. At that time, income tax will say that no arm's length price adjustment is required. I hope all of you are clear. I have said it very clearly, and you need to note also that whatever is the positive adjustment can be done. If it comes to negative, then they say no adjustment is required to be made. So this is called a comparable uncontrolled price method, and how to calculate resale price method. Now what is resale price method? Try to understand the situation. Resale price method. See, let me give one example. This is of one company, एक company थी, जिसका example मैं ले रहा हूँ. One company was there in India named Topaz. Okay, ठीक है, I am just writing the names, may not be relevant right now because they could have changed the right now, but I am talking about a case study which was there. Locational advantage case study was there. This one is a very old case. If you are doing case studies, then it may come like this. Topaz company was there. It was based in somewhere, I can say UK or UK based some company. Just giving the example, so ignore that name. This one is for example. They were having HO or something. What they have done, they have planned that they have employed factory in India. Why they have employed a factory in India? Because in India labor is available in bulk and they are too cheap. Is it okay? The labor is available and they are available in too cheap. What they have done, they have made their sales depot at Dubai, because if you are aware, Dubai is having, it's that country where all the world's banks are available. At the same time, they are having the best of best transport facilities available, and they had this admin office at London, because at that time London was considered to be most advanced as far as the technology or communications are concerned. So what they have done bifurcated like this. See, this bifurcation they have done to promote the business rather than tax saving. But eventually what they have done, they were manufacturing the blade, suppose 20 rupees per packet over here, and they were selling this packet to their Dubai company at the rate of 21 per packet, and later on the Dubai company was selling to the ultimate user at the rate of 35 per packet. Are you clear? So what is the situation? that you can see over here, two methods we are going to apply over here. First, I'm talking about resale method. Then later on, we are going to have a contribution method also. This method say India to Dubai, nominal profit 1 rupee. Why they are charging nominal profit? Because there are huge taxes, or there were, I'm using this word, huge taxes in India. Now, what is the situation over here? What is the profit over here? Profit is 14 rupees per packet. Taxes 0 in Dubai. So at that time, they have said that if you are going to resale price method, this person is not doing any process. He is just packing and repacking and selling the same. So whatever profit is generated over here, or total, that need to be bifurcated properly. So which is the method applicable? You can see over here, we can apply this resale price method also, plus profit split method also. What is profit split method? I'm running parallelly. Investment 100 crores, investment 20 crores, investment in London 10 crores. So now, whenever a company is having a we can say production of one particular product and rotating through 2-3 countries, then we have to allocate the profit depends on their investment. So if the company is having a total profit of suppose 20 crore, then they have to allocate or split. What is the method? You can see over here, profit split method. They have to split the profit in relation to investment made in different countries. So there are two methods are there. One is profit split method, as well as we can apply the resale price method also. And so this is that. So ये हो गया. Next, cost plus method. Now, what is cost plus method? It's a very simple method. I think everybody knows it very well. When we think that cost cannot be calculated properly, this method, selling price cannot be calculated properly because everyone is having their own or different parameters of calculating. Example is, all of you are aware that if you do painting at your home, coloring at your home, painting means coloring work is at your home. If you want to have furniture work at your home, then the carpenter may not be clear, sir, how much I'm going to charge, because your choice is different for different handles, different ceramica, different sheet, different kind of laminates. So he failed to understand your demand sometimes and could not quote you properly. So what he will say, sir, let me do one thing, whatever is the material cost plus my 10% is the profit. Go ahead. Same way, if you are aware, my surname is Sony. All of you please note. If you go with the jewelry showroom, then what happened? They are saying, sir, you want jewelry, you want a ring, you want the R, or you want a butti or something like that. We are going to charge goods plus 199 rupees, 200 rupees per milligram or per gram. Yes or no? So accordingly, their method is very clear. We are going to follow cost plus method. What is the method? Cost plus method, and plus means margin. So normally, if you think that if you are doing a business of that kind of nature, where sales price may not be easy to track, comparables are not available, this product is not easily resold to one to another, at that time the cost plus method will be applicable, and that can be applied. Yes, next one we already have seen, profit split method. That method can be done based on our investment. Same way we may have the method transactional net margin method. That is also same way going along with that, right? In your module you do not have much questions on that part. I request or will provide you the question from the reference book, and I will inform this coordinators that they can transfer this all the material to you so that you can check and calculate the same. Fine. So not going in now much detail of the TP, but I can say that we have tried to cover up some मैंने नहीं करवाया कोई, but I have tried to give you the method and methodology how you can do this one, transfer pricing, that can be done, right? Yes, I have covered over here bulk order, I have covered over here warranty, I have covered over here CIF, BOF cost. You can cover also interest cost. You can also take taxation part. You can also guarantee part also. You can also allied services also. So there are number of adjustments are there that can be done. Okay, and accordingly you can come to the price that's yes, this is my arm's length price, and then compare with the transaction price. Clear? So depends on the situation. This adjustment may vary, and they might be in a very lengthy features. Okay, one question is there in the reference book which says that sometimes, see over here, X company is selling what? AC to whom? Y company. Where? In USA. At the same time, they are selling to whom? Germany. Now, if this company says that, sir, X company says that Y company has provided drawings. What they have provided? They have provided the drawings. They have provided the know-how. And under that agreement, we are charging 3 rupees less per unit. Then yes, this 30 is not controllable. Now comparable, sorry, I can say 27 is comparable. I hope all of you are getting my point, what I wish to say in relation to international transaction, because there are n number of stories are there to compare it. Yes, as we have said, where more than one price is available, you can select most appropriate, or sometimes if you fail to select most appropriate, you can do the average of that also, right? Refer to transfer pricing officer, TPO, very important, sometimes asked. Yes, income tax is having number of income tax officers, number of hierarchies are there, number of employees will be involved over there. It's not possible for all the income tax officer that they have the knowledge of the transfer pricing. They may not have the knowledge of the transfer pricing. They are doing scrutiny cases and they found that there is a question of international transaction. So what they can do, if they feel that yes, I'm not capable or it is not within my purview to check this one, they can say that, sir, why don't you check the case? And that officer is known as a transfer pricing officer. Separately designated officers are there, those who are going to check the data, and everything can be verified at the end. Power to make safe harbor rules. Yes, under safe harbor rules, very important to say, to avoid much litigation, they can prepare the rules ki, yes, in this country this kind of variations is allowed, in this kind of this can be considered as the transfer price declared by the SSE, it's a right. APA, very good thing, advance price agreement. What is APA? Now see one more thing, whenever you have, I hope you will agree with me, if you do this kind of thing with all the SSE, like there was a case of Vodafone, they had faced so many problems of the taxation. People may not willing to be here to in India to set up their subsidiary companies and to do business. They may say, sir, you may apply TP and we may face a problem. So what they can do is they can do advance ruling. One system is there, as well as advance pricing agreement. And this agreement or advance ruling is vetted by whom? Income tax department. They pay fees also. There are certain fees are there, and they say, sir, verify our data and give us a certificate or give us assurance that this transaction is as per the TP price, is as per the arm's length price. And once it is done, then it cannot be questioned later on. That will remain in force forever or for a period defined by the department, and litigations are reduced to a great extent. Fine. While doing a transfer pricing, auditor need to give audit report. Yes, you can see, as I have said, there are certain fees charged for the advance ruling or advance pricing agreement, income tax charges fees. Yes, I think I have tried my best to cover all the parts of the international transaction to the extent possible. I have not touched some of the individual transactions and other small things, but the material is sufficient enough. Even I am going to provide you the questions on that so that you can verify, but I hope whatever is feasible in crash course and what is maximum available, that I have tried to touch upon. We have 10 minutes or something. If you have any question, concern, then you can answer. Tanmay can also help to coordinate if needed. Yes, thank you so much. And as I have said earlier also, let me, yes, if Tanmay Bhai and all, yes, permitted, I think I can give my mail ID, I think, which is also stated over there. This one is my mail ID, parag@paragsoni.com, and mobile number is 98798501008. You can ask question, you can drop a message or WhatsApp if needed, and I will try my best to provide the input as an convenient to me. Fine. Yes. What are the tax haven practically used by Indian resident to tax save tax? Okay, by Indians, normally we use Singapore route or sometime Mauritius route to save the tax. So what should focus areas for the examination? For examination, I would like to say your question areas are case studies. Case studies means from business profession and capital gain chapter. There are Supreme Court judgments are there. I'm not talking about all the High Court and these cases are there, but I'm expecting that you need to see the cutoff point, sometimes critical point. Example, let me give one simple example, as we have sometimes. Section 54. Section 54 says that if a person is selling a property, residential property, and buying a new property, right? Then he is eligible for the benefit of investment made in a new house or capital gain, whichever is lower. So that is the simple position. They are saying that you can buy or construct. What is the condition? You can buy or you can construct. Now the question will be asked, there is one person who has bought one house and is going to construct a new house. Both are eligible. And there is one Supreme Court judgment which says that yes, for both houses. Yeah, so that kind of tricky points can be there. Law says or, but Supreme Court says and. So that will kept in mind. Same way I have used also earlier, agriculture income is exempt. That's it. But it is not flat provision. Agriculture income is exempt. Agriculture income is exempt if it is received from India. Same way, there is one small provision. Quickly, I'm saying ATD is there. ATD, Mediclaim Insurance Policy. There is one biggest issue is there, a point is there, which may be overlooked sometime by many people, that if you are paying the Mediclaim premium in cash, it is not allowed. It must be by account pay check or any other electronic mode nowadays. But if you are paying by way of cash, it's not allowed, even though it's a 2000. Got the point? So these are small tricks lying here and there that can be taken care of. Okay, sir, if income arises in India and company does not have P in India, will such income is taxable in India? I would like to say that to Mukul Soni that if a company if income arises in India, yes, then it is taxable in India. But if you show that you do not have PE and you prove that you are having a TRC, tax resident certificate outside India, then as per treaty, I'm using the word as per treaty, it is not taxable in India. Sorry to say that I have one TRC available with me, but because of certain ethics, I cannot share the TRC with you. Yes, Tanmay bhai, I think voice is coming. You can mute.
Yes, sir.
How
Yes, sir.
can we? No problem. How can we identify the transfer pricing method? Yes, Nirmala, we need to see that. We need to see most appropriate method. Most appropriate method means try to understand over here if goods are there. If goods are there, then best method is what? Comparable uncontrolled price method. See, if you say this mobile, this one is a Samsung mobile. I am selling to Tanmay Bhai at 10,000 and I'm selling to my brother at 9,000. Now, in this situation, you can use comparable price because there cannot be any changes. This is a mobile. Whatever I'm giving to Tanmay is the same way I'm giving to my brother. There is no value addition. Nothing is required to be done. So best method is comparable uncontrolled price method. Now, same thing, if I'm providing services to Tanmay and providing services to my brother, then comparable price may not work because when there is a question of service, I will take care in case of Tanmay. I may not take care in case of my brother because my brother is not going to bother on all that. But Tanmay, who is a third party, may expect that yes, sir should provide timely services and everything should be neat and clear. My brother may agree on that. So at that time, I'm going to follow cost plus method because for Tanmay, I could have taken 3 hours to serve the same service. I have taken 1.5 for my brother. So if service is there, different story. One more thing, if both the parties are related, then different things. Yes, one more, let me tell you one small part. I cannot show the laptop. This laptop is there. I have one person, means I'm manufacturing laptops. Majority parts are manufactured in USA. All the parts are there. Only one part, that's a screw suppose, or I can say a charger, is manufactured by my subsidiary company in USA and India. It is manufactured by my subsidiary company in India. At that time, I can take comparable. Even though it's my subsidiary company, I can take comparable. But if I say 60% of the laptop is manufactured in USA and 40% part, main component of this laptop, is manufactured over there, then I have to go with profit split or contribution method, because both the parties are equally involved in the manufacturing. While in first case, the second party is hardly providing one component of that. So I may follow comparable price or I can follow cost plus pricing method. Sir, what dates or rates we have to remember? You need to remember for all the rates for assessment year 2021, and if you can remember the change dates, well and good. If you remember the previous dates, well and good, because all the dates for these examinations are before 6 months. So you can remember the extended date, that is well and good, expected that you are updated. So you need to remember extended date, well and good, but if you remember the old dates, I think no one can reduce your mark. Fine. Okay, with this I would like to say I have tried my best and I found all the students very cooperative, at the same time too quick when I have asked the question, and found you very good. I'm happy to be with you and to conduct such lecture. Thank you. Thank you so much. Yes, that's my over to you.
Thank you so much, sir, for your valuable time to clear the concept in details on the topic. So thank you so much again, sir. Thank you so much.
Thank you. I'll be happy.
So now
Yes, all the best.
thank you so much, sir.
Thank you.